October 19th, 1987. The U.S. stock market opened like any other day. By the close, the S&P 500 had fallen about 20%, and the Dow dropped 22.6%. Under the kind of bell curve assumptions that shaped mainstream risk thinking, that move sat far beyond ordinary market intuition. So the question is not whether the normal distribution is mathematically beautiful. It is. The question is whether it is the right model for market risk. Because if the tails are wrong, the danger is wrong. And if the danger is wrong, the entire risk system becomes fragile exactly when it is supposed to protect you. The bell curve earns its reputation honestly. It appears whenever many small and roughly independent forces average together. Heights, measurement noise, repeated error. It gives you a center, a spread, and a clean intuition. Most outcomes are ordinary. Large deviations fade quickly. Truly extreme outcomes should be rare. That intuition spread everywhere in finance, parametric value at risk, Black-Scholes style log-normal thinking, mean-variance portfolio construction. Not because practitioners were irrational, but because the Gaussian world is tractable. It gives you formulas, closed forms, and nice-looking confidence bands. The problem is not that the normal distribution is useless. The problem is that markets are not built from independent, stable, well-behaved shocks. Once you stop admiring the bell curve and compare it with real market data, the mismatch becomes hard to ignore. Long-run S&P 500 monthly history shows that 3 sigma losses occurred 10 times in 1,026 months. That is roughly 1% of the sample. A normal distribution would have implied about 0.13%. So even at the monthly level, these left-tail events appeared about 8 times more often than the bell curve would suggest. That is the first stylized fact: fat tails. The second is asymmetry. Big losses tend to be more violent, more abrupt, and more consequential than equally large gains. The third is volatility clustering. Calm days tend to be followed by calm days, and turbulent days tend to be followed by turbulent days. And the fourth is stress correlation. Assets that looked only loosely related in normal periods often become much more correlated in crises. So the failure is not one isolated quirk. It is structural. Now, put numbers on the intuition. A CFA Institute summary of S&P 500 daily returns from January 3rd, 1950 through July 31st, 2012 gives an average daily return of about 0.03% and a daily sigma of about 0.98%. If you take those parameters and ask what the October 19th, 1987 crash means under a normal model, the answer is extraordinary. The move was about negative 20.4%. That translates to roughly 20.85 standard deviations below the mean. Under a normal distribution, the one-sided left tail probability is about 8.1 times 10 to the minus 97. In plain English, the bell curve framing is not just off by a little, it is off by an absurd amount. This is why Black Monday matters so much. It is a direct demonstration that the thin-tailed model breaks exactly where risk managers care the most. Black Monday was the warning. Long-term capital management was the case study. LTCM was staffed by elite traders and famous financial economists. It used sophisticated relative value strategies, extreme leverage, and modern risk systems. Roger Lowenstein reports that the fund had a program implying it was unlikely to lose more than roughly $40 million on a day. But during the 1998 crisis, that comfort evaporated. LTCM lost more than $500 million on a single day more than once. And on September 23, 1998, 14 banks and broker-dealers injected $3.6 billion to prevent a disorderly collapse. The lesson is not that value at risk is worthless. It is that a thin-tailed value at risk can create false precision. It tells you where a percentile cutoff sits under model assumptions. It does not guarantee that the tail beyond that cutoff is small, stable, or remotely Gaussian. Benoit Mandelbrot saw the problem decades earlier. In 1963, studying speculative price changes, he argued that financial markets displayed behavior far wilder than Gaussian models could capture. His language was memorable for a reason. He distinguished between mild randomness and wild randomness. Mild randomness is where the center tells you a lot about the extremes. Wild randomness is where the extremes are not accidents. They are features of the system. That does not mean every return series follows one exact stable law. That claim would be too strong. But Mandelbrot was directionally right on the core point. Market tails are materially heavier than the neat bell curve world suggests. Why do these tails appear so persistently? Because markets are not collections of isolated coin flips. First, falling prices can trigger forced selling. Forced selling pushes prices down further. That creates feedback loops. Second, leverage amplifies modest market moves into catastrophic equity losses. A 10% asset decline against 10-to-1 leverage can wipe out the equity. Third, human behavior becomes correlated under stress. Fear spreads, liquidity disappears, portfolios that look diversified in a spreadsheet suddenly move together. This is why crisis dynamics feel nonlinear. The system changes shape as stress rises. The industry did react. Robert Engel won the 2003 Nobel Prize for ARCH, the class of models that explicitly handles time-varying volatility. That matters because volatility clustering is real. After the global financial crisis, Basel reforms added stressed value at risk in the 2009 market risk revisions. Then the revised market risk framework shifted internal model capital from value at risk toward expected shortfall in 2016, later consolidated in 2019. That is a meaningful improvement. Expected shortfall at least asks the question, value at risk dodges. If we are already in the tail, how bad is the average loss there? But no elegant framework removes the fundamental issue. Tails are hard to estimate. Crisis regimes change. New forms of crowding appear. So model improvement is real. Model humility is still mandatory. What should you actually take away from this? First, the normal distribution can still be useful near the center. It is a local approximation, not a universal law. Second, volatility is state-dependent. A calm sample can radically understate crisis risk. Third, diversification is regime-sensitive. The correlation matrix you trust in normal times is not the one you get in panic. Fourth, leverage and liquidity are what turn statistical mistakes into existential mistakes. And fifth, risk management is not only about choosing a better model. It is about understanding where every model stops being credible. The bell curve is not the villain. It is just too clean for the world it is often asked to describe. Markets are built from reflexivity, leverage, crowding, regime shifts, and panic. Those forces do not stay politely inside thin tails. So if you want to understand market risk, do not start by asking what happens most of the time. Start by asking what happens when the distribution stops behaving. Because markets are shaped in the tails.